Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Monday, June 8th, 2020. Start out here looking at the broad market via the SPY or S&P 500 tracking ETF on a daily time frame. And what we had today is the SPY has rallied in. You have that big gap, very significant gap right here back from, I believe that was Monday. Yes, Monday, February 24th. And what that was, that really kicked off the party to the big drop that down into the March lows. So to kind of recap, you had at this point in time, we had a small wedge, shows better on the 60-minute chart. It was highlighted there. Rising wedge pattern, negative divergence on SPY. And we had 2 days of selling. It broke down. We had 2 days, closed there Friday, and then on that Monday we gapped down, and really the market never looked back. That was really the start. We had a lot of impulsive selling afterwards. So a significant gap for sure to watch. And the bottom of that's around the 323-ish level, right about where we closed today. You can also see there's price support. That level acted as resistance when we were back here. Then it was support here for about a week or so, and then we gapped down to it. And then once we gave it up, it was one of the biggest red candles in years right there. And again, that kicked it off. So that is a technically significant level. SPY happens to enter that gap, then the top of the gap would be resistance. We get anywhere close to it, we'll probably make new highs. Usually, if you backfill that gap or again get close to those highs, usually like a magnet, stops will be set above there, and it's not uncommon to see it popped. To me, the risk reward is not very favorable. I'll tell you another thing to note here is this is the first time. I mentioned this just recently. I guess on Friday we might have got there. First time that we've been overbought on the S&P 500 since late January, right there, shortly before the high. We were overbought there. Put in another second, actually might have tapped the RSI right there, overbought. I know we did on QQQ, and that was it. So certainly worth noting, overbought right now on the daily time frame at significant resistance. And then to kind of recap what happened, we had the big volatility, big volume expansion and volatility expansion off the lows, and then the market set up in a multi-month sideways trading range, nearly 2 months of sideways trading. Broke out or kind of pushed above the top, and then once it broke out, that was it. That was the catalyst. I said at the time, break out. Typically, when you have energy building, it's like, or that's what it is when you have a sideways trading range, especially for so long, it builds energy like a coiled spring, and it could have gone either way, and it went that way. So that's where the market is right now. 60-minute chart on SPY, not much has changed. To kind of recap how the whole thing played out, we had, as mentioned back there, divergence on both the, you had it here on the 60-minute chart as well as in the daily chart. Divergence coming into that high. There was that big gap right there on Monday, the 24th, I think it was, of February, and then that started the party to the downtrend. As mentioned at the time, we put in divergent low back there, which was bullish. That ended the big drop there. Came up here, and we've been diverging higher now for a long time, since early April. You can see these are the divergence lines. I'll expand them out. You can see the indicators making lower or equal highs. The RSI is pretty much equal highs, but yet prices are making higher highs. That's still the definition of divergence, whether you're making lower highs or equal highs on your indicator and prices are going higher. We have a series of gaps that have yet to have been backfilled. Starting here, gap, 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 gap. So that's what's going on in SPY. Zero sell signals right now. We're at resistance, but you really need to take out this trend line here on the 60-minute chart. Same one I've been highlighting for a while. It's not been taken out yet. QQQ on the 60-minute chart. A little bit different trend line. I'm looking at the blue trend line here, and you can see we still have divergence on both the RSI and PPO down below on QQQ. So that's the Qs. QQQ on the daily chart. You can see if I zoom in, let me move this down here. PPO is flattened out. You can see there's virtually no shape or form or separation on the PPO line. But as with the S&P 500, we are at overbought readings for the first time since the very all-time high. That was February 19th on QQQ. All-time high up until today. Maybe yes, Friday. Friday we took that out, and back then we had bearish PPO crossover followed by negative divergence and oversold reading, so overbought. And again, worth noting that this is the first overbought reading since then. So when you look at it this way on the daily chart, QQQ continues to wedge higher. It's that same uptrend line I showed you there, the blue trend line, well above trend. It almost takes the form of a price channel. It is. It's a contracting price channel right now, and you have the minor trend line there. So there it is. No sell signals on the Qs at this point in time. Just some trend lines to watch that could trigger that. Other than that, the momentum is up for the time being. Let's look at the small caps. We still have an active trade there. Obviously not looking so hot. The big thing is when we took out 145.08, that was the whole basis. I'm zooming in here. We shorted after we had that first failure there at 145.0, failed, but then we gapped above it, and we didn't just gap small. We gapped pretty big above it, and we're still above it. So, like I said, there's really no way to spin that as anything but bullish. There is some resistance. That was at next. You could see the next level up here is about 154.65. We came close today. On the official trade, anyone targeting anything but the final target all the way, up to T3. As I said last week, that would have been stopped at actually on Friday. We went above that 149.90 level in the maximum stop, and this is for those swinging for the fences or more. T4 down here. That's still above 155.50, and I still maintain that. So this is still an active trade for now. As with the large caps, this is the first time since the last bull market, is what that was. Actually, I take that back. IWM has been a bear market at top back in 2018, long before the large cap stop. Dropped. But I wanted to point out also this is the last time we were overbought was back here before that big drop. So we are certainly getting stretched, and I can say with the despite the current trend that the risk reward is not very favorable. The trend's bullish, but the amount of upside before a significant correction is not very good. But most importantly, and I say it all the time, overbought is not a sell signal, and so we really don't have any sell signals right now. So we'll watch that. Let's look at what I've been noticing the last couple days and talked about are the risk-off assets, and we're starting to see nothing much so far. Last week I did mention on Friday that we were at support on TLT Treasury bonds during the day, and we had a nice reversal, and we followed through so far. So remember, TLT is one of I call it the king of the risk-off assets. I'd put it more so than gold. Institutions will flock to Treasury bonds. Now, 2 days doesn't make a trend. Remember, we closed red on Friday, but there was a nice intraday reversal, big reversal off the lows, big move for treasuries, that is. And so some follow-up today. So this is the second day, again, not looking at the entire day, off the midpoint of the day on Friday, that we've seen a rally. In fact, I showed you on ZB, Treasury Bond Future. On Friday, that's where we were trading there. I'll have to zoom in a little tighter for you, but so again, you can see that we hit that trend line. So both TLT and ZB hit support. Again, nothing big, could just be a reflexive move, on these tags of support here, but it's worth watching. And then that leads me into the next one, gold. Gold, as I mentioned recently, put in a small divergent low on Friday. Nothing big after breaking support, and it's back at that level. I can't say that it's regained it with conviction, and I'm talking about this 1700-ish level. Remember, gold, very similar to what I showed you earlier in the video, where the stock market about a month or so ago traded in a sideways range. That's coiling. It's like a coiled spring building up energy, and usually the direction of these ranges are determined by which way they break. The next major trend is what I should say, not the direction of the range. The direction of the range is sideways. However, you have to respect when you have these breakdowns, bullish divergence, gold being in a primary uptrend. So we're back there, and I wouldn't say yet that this is a bear trap because we're not comfortably above it, but that is the possibility I laid out, that might be a false breakdown, aka bear trap. You took out this little downtrend line, so good time to kind of sit back, I think, and watch gold and see which way this one breaks. Any way you want to call it, you might want to say at this point in time, since we broke down but we're back to the bottom of the range, maybe it's just a whipsaw like this. So again, gold's grinding around, not the best swing trading vehicle right now because you're going nowhere for months. Silver, we had a pretty good pullback trade, and the update on silver is we took out this trend line, and I did post an update on this quite a bit. I've been updating silver quite a bit recently. We broke the trend line, and we've been back testing it from below. And again, where silver and gold go all depend on where the dollar, not back up. I shouldn't have said all depend. Will likely be impacted by which way the dollar goes. In other words, we had this divergent high, we've had a correction silver, we've had some breakdowns, but there's still big support right here about 17,258. We haven't taken that out. That's right here. So silver, although it's been a little more volatile, you could say is like gold, been grinding around the top. It's not a well-defined trading range up top because we only have that one spike high, but the bottom of that range, a lot like gold. And I'm on a 3-month chart here. Whereas gold, what was I looking at on gold? We were only we were on a 3-month chart as well. Two different looking charts, but they tend to move together, these two metals. Not always in lockstep. And again, right now that puts gold and silver in a precarious technical posture, especially considering the negative divergences they put on the daily chart. If I was a purist, I would say, okay, this is a breakdown, back test, and this is the next objective short entry. And it is objective. However, I'd like to see which way they go here. And again, it all has to do with, in my opinion, a lot of it has to do with the US dollar. The dollar has been walking down this price channel with divergences building. We come up to the channel. We look like we might get a breakout there. It was a little pop, but we didn't get a solid breakout or a 60-minute close above. So we remain in a solid downtrend in the US dollar. That's DX, dollar futures, and need to have an impulsive breakout of this trend line. If we do, I'm still targeting a move all the way back up here to about 98.71. If that happens, that should be net bearish for gold and silver. And look, if the market's going to make it run at new highs and it looks convincing, especially if we go much beyond the previous all-time highs in the S&P 500, that is the other impact. Remember, the dollar is one impact on the price of gold and silver and crude oil. The other impact at times is gold being a risk-off asset. So by that logic, if the stock market continues to rally, breaks out to new highs, that should, all other things being equal, should put pressure on gold as people take profits saying, I don't need gold as a protection, safety hedge, because the stock market's doing great. So we'll watch that. And of course, the euro, same story there. The euro, it's not mere coincidence. The dollar is bouncing along its downtrend line, while the euro, largest component of the dollar index, is bouncing along uptrend line. So again, this will determine likely determine where the risk-off assets go. Let me find crude oil for you. There's crude oil. There's that uptrend line right there on crude. We broke down today, but we haven't really had any follow-through. And I think a big part of that is the fact that the dollar is poised to break out, but hasn't broke out and remains in a downtrend. So, a falling dollar is a tailwind for gold. It's bullish for gold. Lower the dollar goes, it takes more dollars to buy a barrel of crude oil. Now, there's other things here too driving crude, of course. So, reflation of the economy, cars and planes and everything coming back online. But it's certainly diverging and certainly setting up for a nice correction here in crude at this point in time. And we are below trend. So technically that is a sell signal. However, you have decent support right below about 37.40 or so. That would be probably the nail in the coffin if that goes for crude to move down to that 34.76, and quite likely over time going to get a bounce first down to $31 there. Keep in mind as well, the stock market, is likely to influence its chart. If the market turns around and takes a big drop this week, you'd probably see crude moving down as well. Because the two are saying stock market down, all of a sudden economic expectations get dampened, stock market rallies, economic expectations are bullish, and therefore, by that same logic, people will assume there'll be a higher demand for crude oil. So again, those are Sometimes you will see one going up and the other going down. I'm talking the stock market and crude, but for the most part, they tend to move together, especially at times like this when all eyes or all the talk and buzz is about the economy. What's the economy doing? Is it going to get we'll take another big leg down in 2020, or is it going to continue higher to new highs and beyond? And finally, the futures. I don't think I hit on the futures contracts earlier. ES for you ES traders. This is a 1-month chart of the S&P 500 futures. Here's our trend line to watch on the 60-minute time frame, and this one now as well. We have a little minor trend line that gives us this wedge right here. You can see our divergence at this point starting to diverge, and so a break of that. I'm going to give you one more level to watch for you ES traders. Right here we have a little support shelf about 31.86, and so whether we wedge a little higher first or not, look for a break of this trend line right here to trigger a sell signal for a pullback trade on ES with a minimum target right here at these lines coming together, both the uptrend line and that 31.85, 86 level there. It's not much, but should that break, remember we've been diverging for a long time here on the futures, just like the on the 60-minute chart, that is, just like the SPY. And so watch for that. If we went down there, this would be the bullish outcome. Come down, hit that support level, get another one of these little pullbacks. They've come along the way. Again, these divergent highs work. They don't say DH on every one, but that's a divergent high there. That was a divergent high. That was a divergent high. That was not. Or was it? Yeah, we could extend it out. Little corrections along the way, but then sooner or later, if one of these little corrections starts, a bigger correction takes out a more significant level. Remember, this is a little small trend line. A break of that would give you a relatively small pullback. This is a bigger uptrend line. It may lead to additional selling. I'll put up one more level for you just in case that happens. So I do these videos. I like to get the levels out in advance so you have them where to look. Should that level go, that would be your next support down there about 31.28 or 29. ES, and I think I covered NQ. No, maybe I didn't. Let me get to that. Find it here first. Here it is. No, I don't believe I covered this. All right, so same thing, and again, they're not all labeled DH, but you can see divergent high there, divergent high, divergent high, divergent high, divergent high, all the way there. Divergent high, and now our most recent. So what happened today, we were down, and then we popped this little downtrend line right here. See that little downtrend line? Popped it. You can see it clear on a 5-minute chart, 15-minute chart. That was a catalyst for this move up. And what that did is it gave us the latest divergent high. So that's why it says DH right there. Don't have any sell signals right now, but you can see the divergence there building on the 60-minute chart. Could go higher. Probably zoom in tight. Now, this is a 60-minute chart, but if you put this up on a 5-minute chart or 1-minute chart, you probably get a little minor trend line there, and that would be the catalyst for the next drop down there. So if you're an active trader looking to gain pullbacks, a break of that, and then if you want to buy the dip or cover your short, where do you step in? And this would be your first support level right there. I have a reaction high right here, and a reaction low right there. That is 97.41. Step in and cover just above that. Of course, depending on when we break down, if we did it, from around these levels, you're talking about a 1.5% drop right there on QQQ or NQ. And again, that would be a minimum target. The next target there, if we get a little more downside traction, would be this trend line right here. And then you can see some of the other levels there. What probably stands out as one of the bigger levels right here is this one, 95.95. Lots of reactions on that level quite a bit lately. All right, so that's pretty much it. That covers the indexes, those risk-off assets, and again, we'll watch that. If gold starts to rally and can recover that level, treasuries continue to build on this with the market running at new highs. That may be a heads up, but as of now, like I said, there's very few, if any, cracks in the rally other than these small divergences and these pullbacks. So I'll continue to focus on, the more lucrative trading ops, individual stocks, long and short, commodities. The ag commodities continue to firm up and look good, and gold and silver are more active trades right now than really swing trades at this point in time. All right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.